Good morning. This is Jeff Hughes with the Environmental Finance Center at the School of Government. I'm being joined here with Kara Millonzi, my colleague, who's a professor of public law at the School of Government. We are going to provide a webinar today on an update on the authority to charge water system development fees. Before we get started with the content, I just wanted to go over some basics for those of you that might not have used the webinar platform. You should see on your right upper corner a dialog box. If you want to minimize that dialog box, you can toggle between having it be full screen or window screen, as you can see on the screen right now. Hopefully most of you have called in using the phone number, but you can also use audio through your computer if you have good connection. You can see the audio choices there in the audio control panel. We will be providing you an opportunity to ask questions. You'll see on the right-hand box there's a subset of the dialog box that says questions. You can type your questions in there and they will get sent to us, and we'll address as many of the questions as we can at the end of the session. Okay, with that, I'll get started with the content. Again, this is a webinar to provide a general update on the authority to charge water system development fees. This is a topic of concern and interest for water utility managers, finance managers, consulting firms, law firms. Many organizations have followed this topic over the last few years. And we're happy to be able to give you our perspective on the implications of the recent legislative changes. Just a quick word about one of the co-sponsors of this webinar. The Environmental Finance Center, which is part of the School of Government, shares the School of Government mission, but has a sub-mission that relates to promoting the fair and effective delivery of environmental programs. And the topic that we're going to discuss today has obvious implications in how we pay for water and wastewater services in North Carolina. So we have taken a very active role in this topic. The agenda for this morning is my colleague Kara Millonzi will provide a legal overview of the basics of House Bill 436, the bill that caused so many changes in the state framework for these types of fees. I will provide some ideas and examples on what we believe the system development fee analysis will likely look like after local governments and utilities begin implementing parts of HB 436 related to the calculation of these fees. And then we'll finish up with as much time as we have for questions. With that, I will pass it over to Kara Millonzi.
All right, so good morning, everyone. I figured it would be helpful to start, although many of you may be familiar with the history or sort of where we are now with respect to these upfront charges for water and sewer. Some of you may not be, and so I think it would be helpful to start with a little bit of historical context here, and actually not just historical context, but a kind of where are we now. Under current law, for both municipalities and counties, there are essentially parallel general rate-making statutes. And those statutes, if you read them, they're sort of a laundry list of, you have the authority to establish and revise schedules of rates, rents, fees, charges, penalties. The sentence is a very long sentence, and it appears very broad. But significantly, there is some limitation within that authority in the sense that those rates, fees, charges, penalties can be assessed for the use of or the services furnished by any public enterprise. Other water and sewer providers, particularly county water and sewer districts and water and sewer authorities, but some of our other smaller local government entities that provide utility services as well, have slightly broader authority. And we'll get into a little bit of that nuance as we walk through the current state of the law and also what changes we're going to see come October 1st. But the chart that you see up on the screen essentially reflects case law interpretation of those existing statutes, the rate-making statutes for counties and cities. And I apologize, this does not encapsulate the rate-making situation for water and sewer authorities, sanitary districts, metropolitan districts, the rest of our utility providers. I promise I will get there. But right now, what you see up on the screen is essentially was a graphic I created to try to show where the state of the law is, if you will, with respect to rate making for cities and counties. And you'll note significantly on the red light, I use this red light, yellow light, green light framework. Under the red light, you'll note that cities and counties aren't allowed to impose impact fees. And that came out of a North Carolina Supreme Court case, or I should say it didn't necessarily come out of that case, but we found out for sure from a North Carolina Supreme Court case in 2016 involving the town of Carthage. And a lot of what we're talking about today, including the legislative changes, are an outgrowth of that holding by the Supreme Court, perhaps clarifying that local governments, counties and municipalities in particular, had not been in the general rate-making statutes granted authority to charge upfront fees where, as a condition of development, where the fee revenue was going to be used for future expenditures. All right, and so that was only one, though, of the types of these upfront fees that our local governments across the state have been and continue to be charging. And so this chart essentially lays out the state of the law as it is now in light of that Carthage case, in the sense that you had some clearly allowable upfront charges, and those were based not just on the statutory framework, but also on case law interpretations of that statutory framework. But then you had a pretty wide yellow light area, or you might refer to this as a gray area legally, where we just didn't know. There was no case law one way or the other. I had taken a stab based on existing case law and sort of general trends to indicate what I thought would be more likely to be upheld or less likely to be upheld by the courts, and there are the gradations in the yellow light area. But ultimately, we don't know for certain. And so that's where we are in terms of the current state of the law. What has happened is this past legislative session, the General Assembly has now, the best way I could describe it, has now clarified the extent of the upfront charge, or the authority to charge upfront fees for water and sewer systems, and so given us some better contours around what is in that yellow light area. That clarification has actually broadened, in some respects, the known authority for counties and cities, although it has narrowed the authority for some of our other utility providers, and we'll get into the specifics in a few minutes. So first I want to lay out, I want to lay out sort of the general terrain, and this is the terrain that will be as of October 1st, 2017. We are going to have some differences of authority depending on who you're trying to charge, specifically whether you're trying to charge new development within your jurisdiction, existing development within your jurisdiction, or new or existing development outside your territorial jurisdiction, your boundary lines, if you will. And that authority is going to vary somewhat, although I should say in most cases the authority there's been an increase in authority across the board. So that's the good news. The devil's always in the details, of course. And so what we're going to do now, and for the majority of this webinar, we're going to focus in on this new system development fee provision that applies to new development within your territorial jurisdiction. At the very end of my remarks, I will come back to this slide and touch a little bit on the other two categories here. But right now we're focusing in on the system development fee authority, which is really the big new development in the law, again, as of October 1st. All right, so here are some of the things we're going to try to cover. And, you know, I know this probably doesn't reflect all of your burning questions about this new law or about the state of rate making for utilities, but these are the major ones. So we're going to set out the contours of the law. Jeff is then going to come in and fill in some of the calculation details. But of course, in an hour and a half, we won't be able to cover everything. So we'll certainly welcome your questions, and as we go forward, we may be able to address some of them today. Others we may need to address in follow-up. I do have one question, so let me go back a slide just to clarify. Can you help me go back one? Thank you. So to clarify, when I talk about what I'm discussing now, the system development fee, as it applies to new development within your territorial jurisdiction, that is your unit's boundary lines. It is not for cities, your ETJ. I am not referring to your ETJ. I'm talking about your boundary lines. I recognize that many of you, particularly cities and even our water and sewer authorities, others, provide service outside your boundary lines. And we will talk about your authority to set upfront charges for those customers at the very end. But right now, when I talk about within territorial jurisdiction, it is within your actual boundary lines, not your ETJ. So thanks for that question. All right. So we're going to start off, who has to comply? So I said at the beginning that there have been, and there currently still are until October 1st, some differences in the authority for local government entities to charge upfront fees for water and sewer. And I should note that those upfront fees vary pretty significantly from things that units have referred to as impact fees, charged only on new development as a condition of development, to capacity fees and system development fees and tap fees and hookup fees that may be charged or assessed against both new development and existing development. So there's a wide range of upfront charges that you're currently levying. And so we're honing in now on what, as of October 1st, you can do. But who has to do it? The new law, and in particular this provision relating to new development, applies to everyone. So for good news and for bad news, we're going to have some uniformity, at least in the contours of that authority. So whether you're a municipality, county, a water and sewer district, a joint agency that combines one or both, all of those types of entities, water and sewer authorities, sanitary districts, all of our metropolitan districts, and then any government water and sewer provider, water and wastewater provider that's been created by local act, you all now must comply with this new requirement. So the good news is that you all have this new authority. The perhaps less good news is you all now have to comply with all the procedural requirements and limitations in that new authority. So uniformity on that level, it applies to everyone. All right, so let's get down into the nuances of this system development fee. And again, I'm going to keep coming back to try to limit confusion and remind everyone that that's all we're talking about right now. We're talking about the system development fee that all of these units of government that provide water and wastewater services will now be able to assess on as an upfront charge. All right, so who exactly can be assessed? And in other words, what is new development? And the statute pretty particularly defines new development. And it defines it in two ways. So there's both sort of a what and then a temporal timing aspect, a when aspect to the definition of who can be assessed. And so the system development fee may be assessed whenever there is a change that's made to a land or a structure that either involves a subdivision of land or some sort of construction or change to an existing structure that causes an increase for need for service, or some change to land that causes an increase of need for service. So any of those three things triggers this new development, as long as that thing, that either the subdivision or the change to an existing structure or the change to land happens either after this new fee is adopted by your board, or there is this like tiny bit of retroactive authority if that change happened after the written analysis of the fee calculation begins, as long as it's within 1 year prior to the fee adoption. And just to get a little ahead of ourselves, for some of you who may not know at all what that means, this new law is going to require you to each unit of government to have a professional prepare a written analysis laying out the justification for the new fee. And so when we refer to this written analysis of fee calculation, we'll get into what that is in a little bit, but that's the trigger here. The law is not exactly clear about when that's deemed to begin. I think it's, if you're contracted with an outside professional, probably that when you enter into that contract, that's probably a good trigger point. If you're having someone do it in-house, and I think the law supports that, but if you're having someone do it in-house, you're going to need to sort of document a timing in some way that where you've clearly begun that written analysis if you want to use this retroactive timing. But most of you will be using it going forward. After the fee's adopted, that's when you'll start to implement the charge. One thing I want to say about this, and it's important because there's this timing element of this definition, this only deals with who may be assessed. It is not dealing at all when the fee may be assessed. That's a whole different thing, and we'll get into that. So this slide and this description, even though it has a timing element, it only deals with the definition of new development, who may be assessed. So moving on, when can the fee be assessed, right? So we know who. Now the question is when can it be assessed? And I know some of you are like, but what is it? We'll get there. But we want to get some of this preliminary stuff out of the way. So the when, and this is interesting because in some ways we now have a pretty broad authority for whether you're a county, a municipality, or one of these other government utility providers. You have pretty broad authority now to impose a compulsory fee. And that's fairly rare in the water and sewer context. Most of our fees are fee for services with a few exceptions. But look at, if we combine who can be assessed with when it can be assessed, if there's a subdivision of land, as soon as that plat is recorded, you may assess the fee. Or, as the statute allows, if the unit commits to provide water, wastewater service in some other way to that development, that can also trigger the assessment of the fee. Again, the law is not entirely clear about what that means. I think that if there's some early on discussions with the developer before the final plat is recorded, and part of those discussions involve the developer needing the unit to commit to that capacity, and that's reflected in some sort of contractual agreement, that certainly seems to me to be enough to trigger the ability to then to charge the fee. The other thing I want to note is the statutes when you look at the new law, when it talks about when the fee can be assessed, it uses language, it uses the word shall. And for those of you who are lawyers out there know when you see the word shall, that means must. And so I don't think there's a lot of flexibility in this timing. So if you're going to charge the fee, the law is pretty strict. If there's a subdivision of land and that plat is recorded, that is when the fee must be collected. Or, you know, and again, my stats side may be a little bit misleading, so let me be clear. When I say when can it be assessed, that's actually when it may be collected. When it may be collected. The other, so obviously some new development happens when when there isn't a subdivision of land, when there's some other change to an existing structure or land that results in the increase of number of service units. And in that case, either when the property owner applies for connection of a new individual unit of development, or when there's otherwise some other trigger of that increased capacity. And again, that second part might be a little tricky. Obviously, if you have to install a bigger meter, that could be your trigger. But additional capacity may be triggered even if you don't have to install a bigger meter. Jeff may get into this a little bit, but he and I have talked about this. I think he's come up with what may be a helpful tool. It may be helpful to go back and convert all your existing customer base into these service units that we're going to be talking about, so that whenever someone needs an increase in a service unit, they have to reapply, thus triggering this fee assessment or fee collection. But you may figure out another way. Just note that you're going to have to come up with some uniform method to capture that increased capacity trigger in some way. But again, this is when the fee may be assessed and essentially, as a practical matter, when it may be collected. All right, so I know we're running through this pretty quickly, but I want to make sure that we leave a lot of time for some of the meat of the bill, which is the actual calculation. There is a pretty detailed process to adopt this fee. One thing I want you to know, the title of the slide says fee schedule. To this point, I've been talking about this as a system development fee. what you are actually going to enact, in essence, is a fee schedule. And again, Jeff is going to get into this in terms of the calculation, but the fee schedule is essentially going to require your unit to adopt a rate for a service unit and then have a conversion chart or an equivalency table of some sort that applies some multiple or derivative of that rate to different classes of your development, of your new development, to different customer classes, if you will. And so what you are going to get in the end is essentially a fee schedule, all based off a single rate per service unit. All right, so how you adopt this fee schedule, for those of you who have looked at the blog post that I posted, I think it was yesterday now, time's getting away from me, yesterday or 2 days ago, I get into the details a little bit more, but generally your unit's going to have to either hire an outside financial professional or qualified engineering professional who has sufficient legal qualifications, either through education or experience or some combination thereof, to apply generally accepted accounting practices and engineering practices to perform this rate analysis. I note there's various provisions in this new law that seem to suggest that the drafters thought that this was going to be an outside professional, that the units would actually be contracting with an outside party. I don't know, and Jeff and I have had some discussions. He's convinced me that that may not be legally mandated. I'll leave that to you and your attorneys to kind of tease out and figure out what you're comfortable with. But someone that meets the qualifications, whether they're in-house or an outside consultant, has to perform this professional analysis. Once that analysis is performed, it has to be posted on your unit's website. And that's across the board, whether you're a county, a city, a water and sewer authority, sanitary district, etc. If the post on your website has to be out there for 45 days. You also have to invite and provide a form for public input. So whether that be web-based comments or downloadable form that can be filled out, there has to be a form for the public to actually provide comments to the initial draft of that analysis and the rate fee schedule. Once that public input comes in, if you get any, the professional has to consider all of that public input and essentially incorporate it into the analysis. Now, it could be that you get no public input and you're fine to go. It could be that you get public input, the professional looks at it and decides the same analysis is okay, you can go forward, or the professional may decide to make some changes based on that public input. Once that's happened, then the board must schedule and hold a public hearing. And this is on the essentially finalized fee schedule, as well as all the due diligence behind it. After the public hearing, your board may adopt this new fee schedule either by ordinance or resolution, and then it has to provide notice of this new fee schedule either in its budget ordinance or essentially in its rate ordinance. I think you're going to be able to combine steps 5 and 6 by simply adopting this either in your budget ordinance or in your rate ordinance to begin with. Because otherwise it doesn't make much sense. So it may be that you combine steps 5 or 6 if you do it all in one of those two ordinances. And then finally, the law does require that the actual professional analysis be updated at least once every 5 years. So there is some ongoing requirements not to just sort of let this fee sit on the shelf for a long period of time. So you have to do periodic updates at least once every 5 years. So again, this is kind of the bare bones structure of the process to adopt it. The blog post and, of course, the statutes themselves get into much more detail about each of these steps. Okay, how to calculate the fee. I'm not going to say much here because this is really the heart of what Jeff's going to talk about. What you see up on this screen is essentially the directive to the professional who's going to perform your analysis. That person is going to have to follow and essentially check off a laundry list of items that get included into that analysis, including choosing and justifying a methodology of coming up with the rate per service unit and then the conversion table. The one thing I will say here as a legal matter, there's a section of the new law in which the legislature has indicated that the professional chooses a methodology and it uses then the word including and lists the incremental or marginal cost method, the buy-in method, or the combined method. And that generally, when you see the word including, indicates that there is some wiggle room to choose some other methodology that may otherwise sort of comport with the other directives. If you read later on in the statute, though, about how the fee revenue can be used, there's no authority to spend any fee revenue unless one of these methodologies has been used. So you're free to use another methodology. I'm not sure what you're going to do with the money, though. So I think this is one of the cases where the word including might be superfluous. I think essentially right now, at least, you've effectively got to use one of these methods. Okay, and so again, kind of leading into the comment that I just made on spending the proceeds, the law is, and not, this is not unusual in terms of restricting how the proceeds could be spent, and most of it is fairly straightforward, what you would imagine. Jeff's going to get into the incremental and marginal cost or combined cost methods, but essentially that's about having the new development pay for the proportional costs that are to the utility that are necessitated by that new development. And so the money can then be used to cover costs of construction or expansion that are necessitated by and attributable to that new development. The law does allow that if no capital improvements are planned for 5 years, then you may use this money that's being collected for debt service on existing capital improvements. And is the case throughout this new law, we have some definitional challenges in the sense that the law up front defines a lot of terms very narrowly that are then used throughout the set of statutes, sometimes in ways I think probably were not intended, although you never know. And so you may want to take, for those of you who are attorneys, you may want to take a close look at the definitional section to see how comfortable you are with what this money could actually be spent on. With respect to the buy-in method, this is another situation where I think what we may have had is we have some drafting challenges, if you will, in terms of if you look at how you can spend the proceeds in the law for the buy-in method, they read much more like how you might calculate a buy-in method as opposed to how you might actually spend the proceeds. I actually think if you look at the general scheme and the purpose behind the buy-in method, as well as look at how courts have interpreted these types of authorities in the past, I would dare say that you've probably got unrestricted proceeds in your water or wastewater fund that have to be used for water or wastewater purposes within those funds, but are otherwise unrestricted if you use just a buy-in method, because essentially you're reimbursing yourself for costs that have already been incurred in the past. And so there's no good way to say, well, we're going to use that money on things we've already spent money on, other than to interpret it as a reimbursement. This is probably the one area where I've taken a less conservative approach of what the law actually is, I think, trying to say or says. And so again, I encourage the attorneys out there or your units to have your attorney look at this and advise your board about what he or she is comfortable with. Oops. I'm coming in to the end of my time, I promise, but two or three more things here. One about what do you do when you get the proceeds in the door, all right? It's not just about how you spend them, it's how you have to manage them. So for those of you who are finance officers out here, the law actually requires you to create a capital reserve fund if you don't already have one, and to add these monies to a capital reserve fund. For those of you who've taken my basic finance classes, you know that I hate this name. The General Assembly has essentially created lots of unnecessary confusion by labeling this thing as a fund. It is not an accounting fund in the way the general fund or the enterprise funds are funds of accounting. What this is essentially a savings account. So a better way of thinking about it is a capital reserve savings account. It is an alternative to fund balance. When you've got money left over at the end of the year, whether it's restricted or not, that you haven't spent that year, it's a way for fund balance allows your unit to essentially appropriate that money in future fiscal years. This is just another way to show the public or your citizens how you intend to spend that money in future fiscal years. There is a pretty detailed process to adopt a capital reserve fund. And so if you haven't done it before, I've got a couple blog posts out there, or you may want to just look at the statutes. It's in 159-18, sets out the process and the detail. The one thing I'll note is if you want to spend the money that you've put into that capital reserve fund, you actually have to move it first to either your budget ordinance or a project ordinance before you can spend it out. So that's where the proceeds are going to go if you don't spend them in the current fiscal year. All right, so now my final thing that I want to touch on is getting us back to this initial framework. I have been focused on, for the past several minutes, this one type of new fee, the system development fee for new development within your territorial jurisdiction, as defined in your unit's boundaries. A couple things about that. One is that although the law is not entirely clear on this, I think it is reasonable to interpret this authority as essentially exclusive authority to impose an upfront charge on new development within your territorial jurisdiction. Again, your local attorneys may be less risk averse than I am, but I'll note that the law itself, in the bill itself, the legislature has advised the courts to strictly construe the provisions. And so the courts have already been strictly construing any new rate or fee authority. And so I think this is just doubling down on that. And I'd be mindful of that in any interpretation of the provisions. But this is, I think, pretty clearly meant to be the exclusive authority for upfront charges on new development, with a few notable exceptions that the law itself carves out. And you'll note there under this first column, the law preserves a local unit's authority to assess regulatory fees that your jurisdiction already has authority to do. And so for counties and cities, that can be your general development regulatory permitting inspection fees. It can also be your general utility regulatory fees, because there is some regulatory authority in the utility statutes. For all other local government utility providers, it's likely to be the latter. It's likely to be your regulations and any fees associated with them that are directly related to the water and sewer systems. The law also carves out and preserves all units' authority to charge tap or hookup fees, but the law defines those as essentially the direct costs of getting those connections made between the system and the property itself. It also preserves the ability of units and property owners, in this case new development, if we're looking at the first column, to engage in reimbursement agreements or other contractual agreements to get certain infrastructure expansions or capacity increases done outside the system, where you're not actually charging a fee, but you're actually requiring either the developer to do the infrastructure, or the developers voluntarily doing the infrastructure projects and either dedicating them over to the utility, or there's a contractual agreement: if we extend infrastructure, developer, you're going to pay a portion of that. The law preserves those types of agreements. And finally, we do have in a separate set of statutes, some, but not all of our government utility providers have authority to impose availability fees, which are really fees in lieu. They come along if your board could require connection, but a property is not connected. There's some offset overhead charge that can be assessed. And so whether you call it a fee or charge, that doesn't matter so much, but it's a pretty narrow authority that some government utilities have to deal with these customers where the water and sewer is available, but those properties are not yet connected or don't choose to connect. All right, so that's the lay of the land with respect to new development within your territorial boundaries. What about the other things? So many of you right now are not only charging upfront or assessing upfront charges on new development, but you may also be assessing upfront charges on existing development. And so the prime example here would be in our counties that have subdivisions who have either been on wells or septic tanks or both, and now you both have the ability to serve, and those property owners have the desire to receive community water, government sewer services, and there are upfront charges that are being assessed associated with getting those extensions made and and some of which fall in the rubric of these more impact fee type charges. So although the way the law is defined, the new system development fee does not apply to these existing developments that haven't made any changes for additional needs, that are just simply wanting to hook up. What the legislature did was it also went through and amended all of the general rate-making statutes to be clear that you could not only charge for services furnished or the use of the system, but also everyone now can charge for services to be furnished. And so again, I think you have to look at the system development fee set up as exclusive for new development, but this now opens the door to upfront charges for existing development within your jurisdiction. Same thing when you get outside your territorial boundaries. You already, and the case law bears this out, have pretty broad authority to negotiate with your outside customers or your outside customer base. The main difference is that when you do that, it's not compulsory. You don't generally have compulsory authority outside your territorial jurisdiction. I know cities have some regulatory powers in their ETJ, but you don't have compulsory authority to mandate connection or use of your water and sewer systems. And I think that's true here. Although you have broad authority to charge upfront fees, they're on a fee for service, meaning someone wants to hook up to your system, you can say this is what it costs. But you can't compel the payment in the way you can within your jurisdiction. All right, I think I'm going to stop now and turn things over to Jeff. Oh, I guess I'm not going to stop now. All right, one final thing that I should touch on, which is what happens if your unit has been charging these upfront charges, perhaps akin to what we saw in Carthage, or maybe something that's in that yellow light area in that initial graphic that I put up. What's your liability? What we know from case law right now, and this is actually still stemming from that Carthage case, but in this case it's a Court of Appeals opinion, that there's currently a 10-year statute of limitations, or I should say there was a 10-year statute of limitations before this new law was enacted. In addition to that, if a court finds that your local board has done something outside the scope of its authority, it may award attorney's fees and costs in any litigation, and it must award them if it finds there's abuse of discretion. And then finally, for our cities, if you had a subdivision development, new development, and you are determined or found to have imposed an unlawful or invalid fee, you have to repay the fee plus 6% interest per year. So this is kind of the lay of the penalty land, if you will. What the new law did, and this should be good news, although so you see this like awfully large monster out there in terms of the scariness of the potential liability, that monster has become slightly smaller in the sense that what the General Assembly has done is modified a statute of limitations provision to provide for a 3-year statute of limitations for any unlawful fee, essentially, for water or sewer or water and sewer service. Couple things about this. The General Assembly tried, and if you look at the language of the statute, to make this change retroactive. So essentially saying that this was a clarifying amendment to the statute of limitations statute, and it was not intended to essentially change any substantive provision, and therefore giving it retroactive effect, meaning if you had been charging an unlawful fee or a fee that's found to be unlawful for many years, this 3-year statute of limitations would apply. I think that it's to be seen whether this survives judicial scrutiny. It may not be. I think this is good news, at least at the outset. The reality is, in North Carolina, we do have case law that suggests that there is some retroactive lawmaking authority by our General Assembly. That's not true in some other states, but we certainly have that authority. But it's limited, and I think this may be a case where we're right on the fringe of what we know for sure is that authority versus what might be infringing on due process rights. And so what I would say is I think this is good news, and certainly how units should proceed, but maybe proceed cautiously, because we just don't know unless and until this is litigated whether the General Assembly really has this retroactive lawmaking authority. All right, now I promise I'm turning it over to Jeff.
Thank you, Kara. I'm going to switch gears a little bit, and I think this will demonstrate to everyone that this issue and the actions that are going to be going on in the state in the next years, it's going to involve multiple disciplines. You heard that there's very legalistic developments where you are going to want your attorney involved. You're also going to want your finance advisors, your in-house finance staff, your in-house engineering staff, potentially engineering advisors involved in this too, because as you'll see in the next few minutes, what this change does is it makes at least one aspect of water and wastewater fee setting in North Carolina much more prescriptive. We have had in general in North Carolina a fairly discretionary framework for setting rates and fees. As Kara mentioned, we have a fairly broad fee setting authority in North Carolina that was a fairly long and somewhat open sentence that a lot of utilities over the years have used to implement a wide variety of rate and fee approaches. Under this new law, we really now see a very prescriptive fee setting authority laid out, at least for these system development fees. So I think it really changes the playing field. What I'm going to do now is go over some of the processes and some of the terms that are now statutorily defined. And I would advise everyone to be very familiar now with what we are going to have in North Carolina, which is a North Carolina specific fee setting structure. We do, and I will mention it, have references to these generally accepted accounting and engineering planning methodologies, but we now also have a North Carolina law that in some cases refers to these generally accepted practices, but also has some narrowing of these practices that everyone's going to want to be familiar with. So if you use, for example, an out-of-state professional that has done system development fees in Nebraska, you want them to be familiar with the rules in North Carolina for doing system development fees. I'll start with some just general terms and concepts. You do see in the law in a number of places this idea of generally accepted accounting and engineering and planning methodologies. There is not a government accounting standards board for system development fees in the United States. So it's not quite as defined as particularly finance professionals come to think of when they think of GAAP or some other accounting practices. What we do have across the country is a number of professional associations, a number of professionals that have made system development fees and fee setting one of their priorities. The American Water Works Association, for example, has a long history of having peers from across the country develop standards, both technical standards and finance standards. There is an AWWA standard on rates, fees, and charges that has a chapter entitled System Development Charges and System Development Fees. I believe when you read the language of the bill that is probably one of the most important reference documents that was referred to when this bill was drafted. But there are other reference documents that have examples of these generally accepted accounting and engineering methodologies. There's a book. There are multiple books on the topic that are widely referred to across the country, and there are other associations such as the Water Environment Federation that has their take on this. There is a lot of overlap in the terms, and I think if you refer to the law, you will see a lot of overlap in these books and in these guides, but you will see some distinctions. So you'll have to be paying attention both to the law as well as these standards. Probably the most important term is what Kara's already referred to, and it's the overall title of the methodology that you will use to determine these fees. And they really are broken down into three options. They do have that word including, but I think for practical terms, we would advise that you that you pick one of these terms, and these terms are referenced in these general guides and standards. The buy-in method is simply a situation where a utility has excess capacity. Their customers have been carrying the cost of that excess capacity through their fees and charges, and now there's new customers that are going to sign on. It's only fair, so the rationale goes, for those new customers to essentially reimburse the existing customers that have carried that cost. That's why we refer to it as in the buy-in method. Very similar if you're joining a country club and you want to take advantage of all the investments that existing country club members have made in the country club, they ask you to buy in. The incremental cost or marginal cost approach is when you're kind of limited on your existing capacity and you look out 3, 4, 5, 10 years and realize that your system is going to be making many, many investments to serve new growth. If no one else moved into your community, you wouldn't be making any investments. But you have to make these investments because new people, new businesses are going to move in. There's a whole methodology referred to the incremental cost or marginal cost that allows you to look forward, assess the needs of those, assess the value of those projects, and start to put those a little bit on responsibility for those on new development. And the combined is simply a hybrid of these two approaches where there's some elements of both. Some other important terms and concepts that are mentioned in 436. There's this idea of reasoning, analysis, and interim calculations. I think any finance professional or engineer working on a fee analysis you are essentially going to have them lay out their reasoning, analysis, and interim calculations. That does need to be documented. It's not a question where you can get a one-page report. You are going to get a report, a written report that has these step-by-step calculations. And I'm going to show you an example in a minute of what it might look like. That documentation also has to have assumptions and limiting conditions. You can't leave things for interpretation. If you have decisions that are going to change how you apply these methodologies, they need to be laid out. And I would refer to them as, the statutes refer to them as assumptions and limiting conditions. There's some other very specific terms that are in the bill. There's something called identifiable components of SDFs. I take that to mean that you can break up assets into different categories of assets. For example, you can have, for sure, everyone's going to want to break up their system development fees into water system assets and wastewater assets. But you can go beyond that. And in many of these studies, to be more precise, they do go beyond that, where for a water system, you may have a water supply component of the system development fee, a treatment component, a storage component, a distribution component. Your final fee is going to be an addition of all of these subcomponents. So that's what I interpret to mean by identifiable components. There is this term, final system development fee, which ironically is probably not the final system development fee, but it's the system development fee that's going to be recommended in this written analysis. Later on, the board can modify that. But you are going to want to have something mentioned as the final system development fee in a written analysis. Categories of demand is very important in rate setting, and it's particularly important in this system development fee framework that we have. The term categories of demand essentially means breaking up future customers into different groups that share demand characteristics. You can imagine that being residential and commercial. It could be single-family residential and multifamily residential. It can be industry, commercial. There's lots of discretion about how that is done. That's one of those areas where you will have to turn to the generally accepted principles to find out how to do that. There's not prescriptions that say all single-family residential customers have to be treated exactly alike. So that is an area for discretion. And finally, there's this idea of equivalency of conversion table, which I think will make more sense when I show a quick example. Other terms to be aware of that are quite important, and then again, a finance professional or an engineering who does these kind of studies will be familiar with these, but many of you working for local utilities that have not engaged in this kind of exhaustive study in the past may not be familiar with these terms. The idea of a construction and contribution credit, that is a general concept that is very common. There is some narrowing of that definition in the statutes that I urge everyone to pay attention to. That's a little bit more narrow than you might find in some of those general practices. In the case of this situation, if the new development is building a very large water tank that is going to serve their community, but also provide capacity that the utility is going to be able to use for other customers, you are required to give a contribution credit that is going to reduce the value of the assets that you can recover for them. So essentially, they're allowed to pay for some of the cost of their new connection through this oversizing. And you're going to have to use that idea for all methodologies, whether you do the buy-in or the incremental or a combined. There's a concept of actual costs, which has some accounting meaning, but it's, again, a little bit different the way it's referred to in the statutes. The way I interpret the term actual costs is more what we might see in these standards as referred to as the original costs. It's what the actual price of a capital improvement project was when it was put in. That is referred to as the non-depreciated cost. So what you're thinking about, if you built a water treatment plant 10 years ago for $10 million, the actual cost or the original cost would be $10 million. There's a term replacement cost, which is the concept that if you were going to build that plant today, it would not cost you $10 million. It would probably cost you $11 million. That is referred to as the replacement cost. There's a concept of a debt credit, which is very important and is essential for the buy-in methodology. If you still have to pay off $20 million in your water and wastewater system in principal payments in the next, say, 10, 15 years, you are obligated to reduce the value of your assets by that balance that you are going to owe. And there's some other methods they recommend, but the essentially is you are not going to be able to double bill. Once a customer starts paying a monthly water bill, they are going to start paying the cost of principal and interest. So that's a process, and you'll see in my example how that will be used. There's a very small part in the statute that mentions this idea of a grant credit, but I would argue that that's very important. A grant credit means that if for that $10 million treatment plant, $2 million of that was spent by a federal grant, the legislation suggests you should deduct the value of your water assets by that $2 million. So that water treatment plant is really, your investment in that is $8 million, not $10 million, and you will use that $8 million as the basis for recovering and calculating your fee. There's something else referred to as revenue credits, which is very North Carolina specific. You are not going to find the definition of revenue credits as it is spelled out in our statutes in any of those other guides or standards. What this does is give a very prescriptive process for particularly, or not particularly, exclusively for the incremental and combined method of giving some extra credit so that it in effect reduces the fees. And I'm not going to go into this because it would probably take 30 minutes to just deal with this one issue, but this is going to be something that we are going to have to deal with as a group, I think, moving forward, is some of these nuances. But be aware that there are some nuances like that in this bill. This bill is going to formalize what folks at the school government and what folks that advise you have probably been telling you for years. that you should be employing solid financial management practices, that you should understand your assets. If you are going to use this legislation to develop system development fees, those general recommendations now are going to become mandatory. You are going to have a good understanding of your previously completed capital improvement projects, because you are going to have to use those in this written documentation. So having a piece of scrap paper that says we think we have this many assets, or we think this was built, is not going to really hold muster moving forward. There's going to have to be an inventory. Now, we do have very good financial practices in North Carolina, much better than I think many states. So in theory, every local government does have a list of assets for the water and wastewater facility, but you may want to revisit those assets. Those asset inventories may not be as detailed as you're going to want for some of these methods. You're going to have information on the original and replacement value of assets, and that's mentioned in the incremental and combined method moving forward. You are going to have a 10 to 20 year capital improvement program that has accurate estimates of future investments. You are not going to be able to survive, in my opinion, with a wish list. We see some capital improvement plans that are just simply a list of projects we hope to do. I would advise that this is going to require a serious capital improvement program. For every project that you have in the ground or that you are considering moving forward with, you're going to have some fairly accurate estimate of what the capacity of that asset or that asset category is. For water treatment plants, that's fairly basic. You build a water treatment plant, or you have a water treatment plant in the ground, and it is permitted with a certain capacity. You know what the capacity of that facility is. For some other assets in your system, such as water lines or a water tank, it may not be quite so clear to develop that capacity, but you are going to have to develop that. You are going to have to understand what future new development is going to place, what demands they're going to place on those assets in terms of capacity. So I know that's a lot of information. What I'm going to do now is run through a basic example, and this is about as basic as you can get. I think some of you may be able to get away with something this basic, but many of you, particularly the larger cities that are thinking about using the incremental or combined approach, are going to have a much more complicated analysis that would take far more time than I have now to run through. So what I've done is create an example for our city, Happyville. Happyville provides water and wastewater services. They have a water treatment plant that has a capacity of 20 million gallons per day. They have a wastewater treatment plant with a 15 million gallon a day capacity. This is important during a dry year right now. They've been keeping records for the last couple years, and they see that even when people are out there watering their yards, they never exceed 12 million gallons a day. That's good news for Happyville. They have capacity to serve growth and development. There's 8 million gallons a day of existing capacity that they can use for new industrial development, new commercial development, new subdivisions. Wastewater, they have capacity as well. So, as I said, there's going to be a process where you're going to have to develop some assumptions and limiting conditions. And these are just a few that I would give you as examples in my situation in Happyville, is that there are water distribution lines in Happyville, and there's a water treatment plant. From a pure engineering perspective, those water lines may have a different capacity. Some of the water lines may have a capacity of 40 million gallons a day that they can run through the water lines, others 20. For my little example, I'm assuming that the entire system, once it starts to get close to 20 million gallons a day of use, we're going to start to have to make major investments. So that's an assumption, and I think you can stand by that assumption, but you do want to specify that. That assumption is going to let you treat this entire water system as one category of assets. If you had a water system that could only serve 20, but you had a distribution system that you are absolutely can sure serve 40, you may have to break your categories of assets into subcategories, and the analysis becomes more complicated. You've looked through your asset inventory that you use for your financial report that your finance officer handed to you, and it's okay. It has some weaknesses that you want to point out, but the weaknesses are that you think you have assets in the ground that are providing capacity that are not in the inventory. That's a limiting condition. What that means is that your fee calculations are going to underestimate the actual cost, which again is not ideal if you want to recover all your costs, but it's going to help you if your fee was ever challenged to specify this right up front in your document. Lastly, there are some assets that we have in a utility. Think of land around the headquarters. Think of some of the facility equipment that serve both water and wastewater. In my little example, I am splitting all those assets down the middle and saying half go to water and half go to wastewater, and you'll see why that's important in a minute. Okay, so let's get a little example. Again, a finance professional or engineer is going to take a lot more time and spend a lot more time with you on doing this analysis, but this is basically what they will do for you. They will just do it in a more comprehensive manner. They're going to look for information about your assets. This is information that you have in your annual finance report. Every local government in North Carolina has some version of this in a finance report. This is notes on the assets that they have in the ground in order to carry out your finance report. So your auditor is going to be looking at this every year. In many cases, this is just going to be the start for this analysis, and your finance professional is going to want this, but they're also going to want those asset inventory categories. They're going to want maybe an engineering study that was done looking at the capacity and the condition of your different assets. There's a lot of documentation they might ask you, but for the purpose of our little example, I think this will suffice. This shows that Happyville has $235 million of water treatment and distribution assets in the ground. That's how you read that. Those are depreciable assets. That means a water treatment plant that was put in 10 years ago loses a little of its value every year. In the finance report, you can see that the cumulative depreciation of all of these assets over time has been $50 million. So $50 million worth of the original cost of these assets has been used up. So you can't ask new development in some situations to pay that cost. These green shadings are in the areas where it's not pure water and not pure wastewater. For example, land can be split between water and wastewater. Facility equipment that's at the facilities can be split between water and wastewater. So you may not have detail about those assets, but you can make an assumption that those assets can be split evenly. Okay. Right here, and we will make this PowerPoint available to everyone. This is the kind of example that I think is going to have to be included in your fee analysis. What I'm doing now is valuing the water assets, and I'm using a sub-method of the buy-in method that would be referred to as original cost minus depreciation. So the two things I'm doing for this example are buy-in method, which is referred to in the statutes, and then the original cost minus depreciation. That term is also referred to in the statutes, but it's referred to in a lot more detail in the various guides and standards that you can refer to. We know from what I just told you that and I'm only going to focus on the water side for now. I'm not going to focus on the wastewater side. Happyville has $235 million of previously completed capital improvements that provide the capacity that run the water system. There's also facility equipment there that was, as you recall, was $20 million. Half of that goes to the water system. So we got an extra $10 million of assets that are going toward providing water capacity. Land, same sort of thing. There's $20 million in land. Let's say half of that is going to provide water capacity to existing and future customers. So what's the original cost? The original cost is $235,000 plus $235 million plus $10 million for the facility. And already I see a mistake here that I will correct before we send you the slides. This is last minute editing that I did last night. There should be another $10 million addition right here in this formula that is for the land. So if you add these together, 235 plus 10, I apologize again, there should be another 10 here. That would mean that the assets value original cost would be $255 million. You have to reduce it by depreciation of these assets. The depreciation of these assets, again, I apologize for some last minute mistakes that I made in my editing. Please wait for the final version of this PowerPoint before you use this example. It will be $10 million of depreciation for the equipment. $10 million of assets for the equipment. Actually, that's, again, $5 million. I'm going to, again, I'm very sorry for this. And then I'm going to go back over to here because it is accurate up here. $50 million worth of depreciation in those original assets. So you should here see subtracting, and that should be $50 million. If you do that math, and if I had it the numbers correctly, again, I apologize, it would be $200 million worth of costs that you can recover from your system development fees. So the math is simple. I apologize for the incorrect numbers. Is you take your original investments, you minus depreciation, and that is the original cost minus depreciation that you can recover. Because you have $40 million in debt outstanding for all of these assets, you have to deduct that $40 million from this original cost estimate. And because you got $10 million of grants to pay for some of those assets, you have to deduct that. So these are credits that are referred to in the statutes. You deduct $40 million and $10 million from the 200 value, and you get the value of the capacity that you are going to use for your fee calculations as $150 million. So again, errors in the calculation notwithstanding, hopefully you see that it's not that complicated a formula. What are your original assets? Deduct the depreciation, deduct the debt, deduct the grants, and this is what you say you can recover.
Jeff, can I interrupt for one
Yes,
second? Because I saw a question come up where someone said, well, I thought we only had to do the grant and the debt credits with respect to the incremental marginal cost method and the combined method, and not the buy-in method. I think where that confusion is coming from is that those credits are listed under 162A207, but essentially the same types of credits are mandated by 162A211B when you use the buy-in method. So that's, unfortunately, the statute just kind of splits them up, but it's essentially the same sort of requirement. So I just wanted to point that out.
And again, you can tell that there's some confusion here. The law does not mirror exactly the same guidelines that you'll see in, say, the M1 guideline from AWWA. Grant and debt credits are an essential part of the buy-in method, they are actually not an essential part of the incremental method if you look at any standard. So the fact that our statutes refer to those under the incremental buy-in and combined is going to be confusing for a finance professional. So again, we're going to have a very North Carolina specific method here. So let's get to the punchline here, and we are getting close. We've assumed that all of the assets that you have in the ground for your water system provide 20 million gallons a day of capacity. We've already acknowledged that there is plenty of capacity to serve your new development. So let's figure out what is going to be the service unit building block for your fee. This is not a complicated calculation. You've just calculated that your value of your capital projects that you are going to ask all of your future customers to cover is $150 million. Your overall capacity is 20 million gallons per day. That means that you can demonstrate quite convincingly that you have $7.50 invested for every gallon per day of capacity in your system. Somebody that comes to you and needs a gallon per day of capacity, you have clear documentation that says we're going to charge you $7.50. So this is really the most important calculation and how these fees are going to be calculated. So Happyville, in other words, Happyville can recover up to $7.50 per gallon per day that a new customer will use. Okay, so what will your customers use? A few words about taking that building block calculation that you will have and applying that to the real world. Someone knocks at your door and they say they need capacity. You're going to need some type of conversion table to know what check they need to write to you. In Happyville, we know from looking at the billing records over the years that the average residential customer uses 6,000 gallons per month in July. That translates to 200 gallons per day. Why do we use July? Because we know that's the kind when the customers use their maximum amount. So that's really the way we are allocating capacity in this situation. But here's the interesting thing, which is anyone that works in the utility business knows, is that your single-family customers, if you looked at their billing records, they may be using 9,000 gallons per month, which is 300 gallons per day. Your multifamily accounts are actually likely to use much less than this. If you look at a duplex or apartment, the numbers that we see are much closer to 3,000 gallons per month. So right now, you're starting to have a discretionary choice. Do you treat all of your residential customers as the average, or do you have a system in your utility where you are going to have a conversion table with customer categories that treat these customers differently? So, for example, you have an option that all residential customers with the same meter size, they walk in your door, it's 6,000 gallons per month, 200 gallons per day times times $7.50. That will be a fee of $1,500 that you can charge them. Option 2 is to use the information that I said that you have to refine your allocation. You could have a charge where multifamily, they only use 100 gallons per day. You charge them at that building block rate, and you charge them for $7.50. So you can see, if you are a utility, if you want to promote affordable housing in your community, or you want to be fairer with your allocation, if you do this way, you are going to have a much larger range in what you are charging residential accounts. This is acceptable, this top one, option one, but it's going to be a discussion that your finance professional and your community is going to have to make. We see in North Carolina a number of approaches for using upfront charges, and I think those are going to be able to be largely translated into this new system development fee. We have some of the coastal communities which allocate these fees based on the number of bedrooms. Our utility in Chapel Hill uses the square footage of property to decide how much they're going to charge different residential customers. They've done a study and they see much more of a connection to the square footage of property in assessing the need a new customer is going to need than if they just use, say, meter size. So the higher the average fee that you have in your situation, the more of an argument for being precise from a fairness standpoint. I'm not sure you're legally going to be required to be precise, but it's going to be a decision that you have to make at the local government from a fairness standpoint. What about the non-residential categories? Well, here's where we get to a term that's in the statutes called the equivalent residential unit. I've just told you that you can look at all of your residential units as average, and they use 6,000 gallons, 100 gallons per day. You can set this as an equivalent residential unit. The way that would come to play is a shopping center comes to you and they tell you, or you estimate, that they are going to use 60,000 gallons per month. That is equivalent to 10 average residential accounts. That's where, when you see the term equivalent residential unit, that's why they're referring to that. And this is something that many people use. If you wanted to do it on that ERU basis, the shopping center would pay 10 times this calculation for the equivalent residential unit, which is $1,500. They would pay $15,000. I do want to point out that you don't have to go to this extent of using this equivalent residential unit if you don't want to. The legislation says that that's typically the way to do it, but I am actually seeing a lot of utilities that just stick with the building block approach. You've already calculated what the cost per gallon per day of capacity is. You can use that and you get the same outcome in this particular situation. 2,000 gallons per day for the new shopping center times $7.50 per gallon per day equals 15,000. The more billing data you have, the more precise you can be. You could use an alternative approach than the one I outlaid. Rather than worrying about what usage an individual property will actually use, you can do something that we've done for years in this field, and that you can assume that a property will use as much water as can go through the meter size. I personally am seeing a lot of weaknesses in that approach. We have a lot better meter technology than we did when a lot of these standards were developed. Meters are a fairly rough and imprecise way of allocating demand across customer bases. A duplex house with a 5/8 meter will never, I repeat, unless they have, will likely never put the demands on your system as a single-family house with an acre yard with the same meter size. Yet, if you are stuck on meter size, they will always pay the same system development fee. But you do see in the guides the ability to just use meter ratios as the way to allocate those costs, where you say the meters that a residential customer would typically use is your equivalent residential, and then you just look at the ratio of the meter size that you put in for a shopping center. So in our case, if the shopping center only needed a 1.5-inch meter, even though we know they are going to use 10 times the amount of the average residential unit, if you are relying just on meter ratios, the old meter standards tell you that 5 times the water can flow through a 1.5-inch meter than can flow through a 5/8 inch meter that a residential account would do. Therefore, this would suggest you charge in your equivalency table 5 times, which is less than what I show you up here. I know I covered a lot of financial calculations. We had a lot of questions where people were hungry for some examples. Hopefully that gave you some idea. I will post the PowerPoints with corrected slides, and I will show where there was a mistake in that PowerPoint slide that I showed you with my core calculation, so it will not confuse anyone in the future. And we will also put some of these calculations up just as standalone calculations. We have approximately 10 minutes to cover probably about 4 hours of questions. So what we're going to do right now is cover just some of the very key questions that we've received 5, 6 times. There's a number of other questions that we've documented here, and we are going to be using those to develop additional FAQ sheets that will be pushed out. So if anyone is interested in that, I urge you to follow our the blogs that the School of Government has. Kara mentioned a blog yesterday that she did, which is our Coach Cannon blog. The Environmental Finance Center has a blog. We have listservs. We have our new NC Finance Connect. Hopefully you're familiar with all these tools. They're easy to find if you go to our website, but those will be other ways that we push out information about this important topic. So with that, I'm going to turn it over to Kara to answer some of the questions that we've already had in the past and that we've seen coming in. And then again, we're only going to be able to get so far.
Okay, so question number 1, does the law apply to our for-profit water associations? And the answer is clearly no. This law applies to all of our government entities, counties and cities, but also water and sewer authorities, county water districts, all various metropolitan districts, sanitary districts, and then some local acts, but it's a government entity only.
If you are a water co-op, Davidson Water does not have to follow this. If you are an investor-owned utility, a private utility, nothing that we talked about today applies to you.
So the next question is, can I clarify when the fee must be collected from newly subdivided property? Okay, so what the statute says, that if so recall, just as a little bit of background, that you collect this fee may be assessed and collected from new development. And new development happens when one of three things happens. Either there's a subdivision of land, or there's some change to land or structures that results in increased demand for service. So if the change is a subdivision of land, all right, which is what we see often with new development, a subdivision of land, then the fee must be collected either when the final plat is recorded or when the local government entity, the local utility, otherwise legally commits itself to provide the service to the new development, which may in some cases happen before that final plat is recorded. The next question relates to how to administer the funds. And the question is, if we use the buy-in method and essentially we're reimbursing ourselves for past costs, do we have to put the monies in a capital reserve fund? Well, the answer to this question is that practically, if you're going to spend the money this year to reimburse yourself, use the money to reimburse yourself and spend it on something else related to your water or sewer system this year, then no, you just keep it in you allocate it through the annual budget or through a project ordinance and spend it this year. But if you're going to not spend that money this year, you're going to spend it next year or in future years, then yes, it has to go in the capital reserve fund. Oh, so what provision bill leads that it's restricted to the corporate limits? So here's where it gets very, very hyper-technical. For those of you who know how the way it works in our state, we are a non-home rule state, so all of our powers and authorities are derived from the General Assembly. The general rule of statutory construction in our state is if a provision it's a specific statutory provision that allows a county to do something or a city to do something. If it doesn't specifically state that it allows it to do that outside its territorial boundaries, then the default is you are only allowed to do it in your territorial boundaries. And we have case law on this in both the fee and the tax context. And so you have to sort of look at a much broader scheme of things to understand how all this fits in. And so generally, if a statute says that you can't, if the statute doesn't say you can use your powers outside your territorial jurisdiction, you may not. In the water and sewer context, we have our public enterprise statutes for our counties and cities, and obviously our other utility providers have some parallel authorities that clearly allow your unit to provide services outside your territorial jurisdictions, and that's very common, where you're allowed to provide the services outside. But again, those provisions apply to voluntary services. So you may not mandate or require anyone outside your territorial boundaries to sign up or use your utility services. That's essentially all outside your jurisdiction. It's all on a voluntary basis. Somebody wants the service and you're willing to provide it, then you work it out. And the law on setting fees and the terms of that service is pretty clear that you have much broader authority in that context than when you're doing things inside your territorial jurisdiction. For cities and counties, it's very explicitly laid out in the mandate statutes that you can only mandate service within your jurisdiction. In some of our other utilities, it's mandated, or some of our other laws for other government utilities, it's mandated. In others, it's sort of applied from this general framework. So that brings us to our new law. The new law, if the General Assembly had essentially just modified the general rate-making statutes to allow for rates and fees to be charged for services to be furnished and left it at that, then I think, again, you don't have the authority to mandate, but you would have the authority to charge upfront charges outside your jurisdiction. And so I think clearly you have that authority. But then the General Assembly went further and enacted this system development fee in a totally different chapter. So this is in 162A. It's not in our county statutes. It's not in our city statutes. It's not in the statutory scheme for any of our other government utilities. It's essentially a standalone provision now. And that set of statutes does not specify that authority applies outside your territorial boundaries. The other thing about that, to the extent that you might argue, and I'm sure some of your attorneys will argue this, well, maybe there's some way to connect it to the rate-making authority, and I get that. I get that there may be an argument there. The problem with that argument is twofold. One, we have this directive in the law itself that says it should be narrowly construed. Two, you don't have any other mandated authority outside your jurisdiction, and so it would seem very odd, and I find it really hard to believe that a court would say you could mandate this fee whenever there's a subdivision outside your territorial boundaries, but you can't mandate service provision. It just doesn't fit. So I think there's both a plain language argument that it doesn't work and also just a contextual argument that it doesn't work. So question, can you clarify, you can't compel a property outside your territorial or city limits to connect, and the question is, well, can we require someone inside our city limits to connect? The answer is maybe. The answer used to be a more straightforward yes. But what has happened in recent years is the General Assembly has narrowed both cities and counties and water and sewer authorities and sanitary districts authorities to mandate connections within your territorial boundaries. That gets into a lot of nuances I probably can't cover right now. I will tell you there's a blog post on it. If you want to email me, I'm happy to forward you the set of blog posts that now lays out the circumstances when you can compel and when you now can't compel because of existing wells.
Okay, we have time for just one or two more questions. There was a question about stormwater. Stormwater is noticeably absent, which I found particularly interesting. We don't have a culture of stormwater system development fees quite as much as we do for water and wastewater fees, but there are some out there, and they are not covered by this bill. I think we're gonna wrap up now because we want to make sure that anything we say everyone gets, and we said we would wrap up at 12 o'clock. We do have a list of questions, which we will follow up both individually as well as in a widely dispersed FAQ sheet. Again, I hope this was somewhat helpful to you. We realize that this is a complicated law that has both finance and legal repercussions, engineering repercussions, and in looking at the questions, I've seen very specific engineering questions and very specific legal questions. So I think this is going to be something where Kara and I are working together into the future on for a while. But with that, we are going to close up. This webinar will be recorded. It was recorded and will be posted, and then we will have a PowerPoint that we send out within a day that again has that one corrected slide in it. Again, I apologize for that, but otherwise, thank you very much for your time, and we're here to work with you moving forward.